Your roadmap to the latest in auto? Welcome to Highway Herald. Here, we go beyond the engine bay to explore the forces steering global markets. In early 2025, China redrew the energy map, leaving U.S. oil exports out of the picture. Tariffs of up to 15% on American crude, LNG, and coal sent Chinese refiners fleeing overnight. Barrels once bound for Shanghai vanished, and just like that, the world's largest oil market pivoted, triggering a seismic realignment that changes everything. Tariffs ignite a meltdown in U.S. oil exports. In February 2025, China imposed a 10% tariff on American crude and a steeper 15% levy on LNG and coal, sending immediate shockwaves through global trading floors. U.S. energy shipments to China didn't just decline, they vanished almost overnight. Chinese refiners, once steady buyers, swiftly walked away from U.S. barrels, even when offered at fire sale prices. The collapse wasn't announced with headlines, it unfolded in silence. At key export terminals, the numbers told the real story. From a robust 160,000 barrels per day in early 2025, U.S. crude exports to China dwindled to nearly zero by mid-year. Contracts lapsed, bookings were abandoned, and tankers that once sailed confidently across the Pacific were rerouted elsewhere. Even a temporary 90-day tariff truce couldn't revive the trade. The infrastructure had already pivoted, and the sentiment along with it. American crude simply didn't fit the new equation anymore. Terminals, pipelines, and port systems built to serve China now stood underutilized. What's gone isn't just the volume, it's the vision. The U.S. energy map into China has been erased, with no clear route back. But China didn't just stop buying U.S. oil, it rewired the entire supply chain to ensure it wouldn't have to rely on it again. China re-engineers its energy network. With American crude sidelined, Chinese refiners didn't flinch. Instead, they executed a full-scale supply chain pivot with surgical precision. Russia led the charge, offering heavily discounted barrels that mostly flew under the radar of Western sanctions. Close behind were Saudi Arabia and the UAE, stepping in with dependable volumes at stable, long-term prices. Even Iran, despite sanctions, slipped in through the cracks, feeding smaller teapot refineries via a growing shadow fleet that deftly avoided regulatory scrutiny. By mid-2025, analysts estimated China was bringing in around 1.7 million barrels per day of Iranian crude, most of it quietly rebranded or rerouted. This wasn't a short-term patch job, it became a master plan. Multi-year contracts, often Yuan denominated, reshaped loading schedules, payment channels, and blending logistics. Refineries were humming at full tilt. June 2025 output spiked 8.5% year-over-year, hitting 15.15 million barrels per day. With a 1.42 million BPD surplus, refiners had room to store, resell, or redirect at will. And here's the punchline. Pipeline flows shifted, currency rails changed, and American crude simply vanished, deleted from China's new energy equation. Before we delve deeper, take a moment to hit subscribe. If you're finding value in this breakdown, show your support by subscribing to Highway Herald. Your clicks help us keep delivering content that fuels your curiosity. Now let's examine how China's oil shift ties into something even bigger, its challenge to dollar dominance. Yuan over dollar, a new financial gear shift. But the real masterstroke? It's not just where China gets its oil, it's how it pays. Yuan-based energy contracts aren't just headlines, they're quietly rewriting the global oil order. In 2025, deals with Russia, Saudi Arabia, Iran, and the UAE increasingly bypassed the dollar entirely, cutting the US out not just as a supplier, but as a financial gatekeeper. This isn't symbolism, it's infrastructure. From pricing models to payment clearance to maritime insurance, China's energy architecture is being rebuilt to run on yuan. That means US crude doesn't just face tariffs, it's shut out of the billing system. Even if prices drop, access is limited. American oil can't just undercut the market if the pipelines, contracts, and settlements no longer speak its financial language. And this is the existential question now hovering over the Gulf Coast. Can US oil re-enter a system explicitly engineered to operate without it? And while financial systems shift in the background, the physical infrastructure on US shores tells a story just as stark. Stranded terminals and the Gulf Coast's unused muscle. Across the oil-soaked coasts of Texas and Louisiana, once thriving energy terminals are now eerily quiet. Facilities like Loop, Ingleside, and a web of Gulf Coast hubs were engineered with one destination in mind: China. For years, they stood as monuments to booming demand from the East. But in 2025, with that demand suddenly vanishing, these vast export complexes now face a painful reality: underutilization. Desperate to redirect shipments, U.S. producers are looking toward Europe, India, and Latin America. But those markets are already saturated, fiercely competitive, and lack the long-term security that China once offered. Margins are tight, and deals are harder to land amid entrenched rivals like Russia and the Gulf states. Now, pipelines flow at partial capacity, oil storage tanks sit in limbo, and billion-dollar terminals risk becoming stranded assets. For many in the industry, this is more than a downturn. It's a reckoning. Unless U.S. strategy or geopolitics shift dramatically, the infrastructure gamble on Chinese growth may never pay off. Producers must rethink not just direction, but purpose in a world China is now reshaping. And if China's supply chain shakeup wasn't enough, its geopolitical strategy is laying the groundwork for even deeper decoupling. China's oil playbook and the great global energy rewire. By mid-2025, as U.S. and Chinese diplomats met in Stockholm, energy was conspicuously absent from the top-tier agenda. But while words were exchanged at the negotiating table, China was sending a louder, clearer signal through its actions. Rather than yield to U.S. pressure, Beijing doubled down on energy independence, deepening partnerships with sanctioned exporters like Russia and Iran, and broadening its already diversified supplier base. The so-called tariff truce that reduced energy tariffs to 10% did little to change the equation. American oil remained too expensive and strategically irrelevant. Chinese refiners accelerated stockpiling efforts, building a surplus exceeding 1.42 million barrels per day. It wasn't just inventory, it was leverage, a geopolitical shock absorber that gives China control over market volatility and price swings. Meanwhile, a second revolution was happening on the roads. With over 14 million EV charging stations and nearly half of all new cars sold being electric, China's long-term strategy is clear: reduce dependence on oil itself. While flashpoints like the Strait of Hormuz linger, China's supply web holds strong, and U.S. oil is no longer part of its future. Verdict: the final turn. Is U.S. oil doomed to stay locked out? What's happening isn't just a dip in exports, it's a strategic reset. The U.S. has been gradually pushed out of China's oil market, not by one policy, but by a series of shifts: tariffs, alternative suppliers, Yuan-based contracts, revamped logistics, and a booming EV movement. Even with tariffs lowered to 10%, China isn't looking back. Its energy ecosystem is self-sufficient, diversified, and built to exclude American crude. For U.S. producers, this presents a stark truth: even cheaper oil or eased tensions may not open the door again. The architecture is now designed for a future without them. Let's hear from you. Can U.S. oil adapt, or is it stuck with outdated infrastructure? Is China's Yuan oil strategy a threat to the dollar, or just smart diversification? What would you do to bring U.S. oil back into the game? Drop your thoughts in the comments. We're reading them all here at Highway Herald. Don't forget to subscribe and hit the bell icon so you never miss our deep dives into the world of vehicles, energy, and global power shifts. Thanks for watching, and see you next time. You can now check out any of the videos on the screen. There's more exciting and informative content waiting for you.